Welcome to the Lend Academy podcast, session number 30. This is your host, Peter Renton, founder of Lend Academy. We are kicking off 2015 here on the podcast with a fascinating company and a fascinating guest. Rohit Arora is the CEO and co-founder of Biz2Credit. Now, Biz2Credit have been somewhat of a quiet achiever. Their name is becoming mentioned more and more, but they're not still probably the household name that a company like On Deck or Lending Club is. I think that's going to change. And with the podcast today, we'll learn a lot about what Biz2Credit's doing, some of the real groundbreaking work they're doing in small business lending, and just how successful they're being in attracting investors, in attracting borrowers, and really the returns they're providing are nothing short of excellent. So hope you enjoy the show. Welcome to the podcast, Rohit.
Yeah, welcome for the opportunity.
Okay, so let's get started. Just tell listeners a little bit about yourself. Can you give us some background and how you came to start Biz2Credit?
Yeah, so Biz2Credit was started in summer of 2008 by me and my brother Ramit. And being first generation immigrants into this country, I came here in fall of 2003. So a pretty recent immigrant. So one of the things that struck both of us was that even during the last credit boom, while the mortgage availability was there were a lot of brokers and there were a lot of assistance from banks. There was a big issue with small businesses who were trying to get access to credit, and they were having a very hard time in doing that. Especially with immigrant businesses, it was even worse. And that's how the idea came to set up an online platform where business owners should be able to get access to the best credit options that they should be availing at any point of time in their business.
Okay, so did you have any background in credit yourself, or did you just see you saw the problem and you wanted to fix it?
Yeah, so my background was, I started my working career with GIC Singapore, which is a big sovereign fund, and actually was part of a fund where we were investing money in companies in India and China, and by using Singapore as a front end. And so that was in late 90s, early 2000. And one of the companies that we put money at that point of time through our fund was Alibaba, which now everybody knows because it was all a SMB play and a logistics play. Mm-hmm. So when I came to US, I had an idea that, because I could figure out that, say, technology is changing a lot of stuff in the emerging markets, but also in US. And one thing that struck me at that point of time, or two things that struck me at that point of time, one was that, in the mobile space, US was far behind the rest of the world, especially Asia. And the second thing was that, still a lot of stuff in the SMB space in US, whether it was, credit, whether it was, SMBs trying to, get a new location or trying to, buy insurance or everything else was still pretty much offline. And the whole technology market was more focused on the consumer stuff and less on the small and mid-sized businesses.
Mm-hmm. Mm-hmm. Sure. Okay.
So that's how we started the business. And my brother, who used to work in Citibank in India, and then came here and was working with Xerox as a financial analyst. So both of us had financial background and at the same time understanding of where the gaps are there in the market.
Sure. So then can you tell us what exactly Biz2Credit does? I mean, obviously you're providing financing for small business, but how does it work?
Yeah. So Biz2Credit, as I said, so we started it off as a marketplace where we said that, it should be a marketplace which should be intelligent marketplace. So what we mean by that is that, we should have the ability to act like virtual CFOs. And for doing that, we looked at various models, and one model we found was that in 2008, most of the platforms, even on the consumer or mortgage side, were doing lead generation. So we said that, as Biz2Credit, we will not be a lead generator. So what that meant was that we will not get the customers in and then, sell that information to lenders. Mm-hmm. So we said, we have to do a lot better than that. And that was, the whole genesis of Biz2Credit. So we said that, what can we do better than a normal lead gen platform? So we identified 5 big touch points for businesses, and they were accounting. So, businesses maintain their books, or their accountants do. They run their payroll, or their payroll is run by a third-party company. They put a lot of money in trying to market their businesses. It used to be more offline and a lot more online now. But obviously, marketing was a big challenge for them at any given point of time. They had a payment stuff, so whether they were invoicing or accepting credit card payments. And they were also filing their taxes, whether they were sales tax or they were quarterly tax returns or they were annual tax returns. And what we found out was that, in most of the things that they were doing, either they were using a third party or if they were doing it on their own, it was very manual driven. So we said that, if we take into account all these 5 touch points, this generates a lot of data from a credit perspective. And if we have the ability to go and build the pipelines into different accounting packages and into payroll products and into, other aspects out there, what I just mentioned, then without having to ask the customer a lot of information on an ongoing basis, with their consent, we will be able to get that information and will be able to plot their credit worthiness. Mm-hmm. So then, offering them credit becomes just a process and a product, because if we are able to benchmark them, scorecard them, help them to keep improving their credit worthiness, and by promising the customers that we will make money only if you get funding and not selling their leads to anybody else, we said, why don't we? So that will create a lot of trust. At the other end, what we started doing was that we went to lenders and told them that, we are not going to sell you leads, so you don't have to pay us anything upfront. But in lieu of that, you give us your underwriting criteria. And for a lot of lenders, initially it was a big, no, but they eventually realized that was a better way. So we crowdsourced a lot of underwriting models, in the beginning. Now that gave us a very good insight into, what the lenders are doing, what they are doing well, what they are not doing well, what level of information they're asking. And in lieu of not selling them leads, we also forced them to give us all the performance data back to us. So like we said, okay, we are not taking any balance sheet risk, but we should still have all the performance data on these loans being made through our platform. That way we will be able to help both the business owners to keep improving their creditworthiness, as well as help the lenders, because we will be able to benchmark the borrowers, we will be able to benchmark them against our scorecard, and then we can help the lenders to build better products out there.
Okay.
So that was the whole genesis.
Okay. So I want to touch on a couple of points there. But first, the virtual CFO thing that you talked about, where you go in and, you provide, basically a part-time CFO. Is that a service you still offer today? Can people, get into Biz2Credit as a client without actually taking out a loan, or are you purely just a loan marketplace today?
Yeah, so, we still do that. And what we have done is that whole virtual CFO concept, we have automated it so much so that even today, when a business owner goes in and let's say, they want to sync their bank accounts, they want to sync in their accounting packages, they want to, get the data from IRS. So we provide all that. They can actually, and they get a Biz Analyzer score, which is a culmination of their personal credit scores and the business credit and all the cash flow analysis and the industry risk. And they get a doc vault where they can store all their docs and their accountants can work with them. So the whole philosophy to today is that, we will help you as a virtual CFO, and we make it so easy for you as a business owner to go in and do things which you normally won't do. Like one big challenge for most of the businesses is that their documents are never stored in one place. And every time they are going to apply for any lending product, once you have gone beyond a typical cash advance, then the lenders will need your tax returns for last 2 or 3 years. They need to do all the cash flow analysis. And every time the borrower either scampers for it or will go back to their accountant, want to get it from them. So that's a big nightmare for a lot of these guys out there. So what we have done is that when we initially started, it was manual to a certain extent, but over the years we have automated it, and the benefit of that is that we actually have a very high customer retention, and we can actually upsell them a lot more credit products, and the performance of those customers on our platform is great, because before the default, let's say they get into any problem, we can see that, we can help them with the solutions. And then we also have a team of credit trained loan specialists who actually have very sophisticated dashboards. And then, today we provide every customer an ability to do a free loan consultation. But once they have to fill out all the stuff and they have to give us access to their data. And by doing that, we have seen that we are able to attract and retain very high quality customers, which typically in the industry is a challenge because companies spend a lot of money in just acquiring customers, while our philosophy is that acquiring customers is one part, but retaining and growing those customers over a period of time is actually more important.
Sure. Okay. So then just on those customers, who are the typical clients? I mean, these are small businesses, obviously, but do you specialize or do you seem to have a concentration in certain areas? I mean, who's applying for loans?
Yeah, so that's a very good question. So today, Biz2Credit runs a institutional platform as well as a banking platform, and the one platform works in conjunction with the other as well as it competes. So the kind of customers that we get, could be, in certain cases, could be pure play startups, which get funded through our SBA loan program, which is part of our banking platform. We have micro lenders like Axion and Valley Economic Development Corporation who are fully automated through our platform, and these are the guys who will actually fund more very small businesses and businesses typically not getting funded through our institutional or through our traditional banking platform. And then we have an institutional platform where we have seen that by attracting such high quality customers, a large number of our customers there have average age of business of between 4 to 5 years, have revenues of more than $1 million. And what we are seeing is that by giving the customers a lot of transparency and an ability to move between the institutional products and banking products, we are able to attract very high quality customers on the institutional platform. We are able to retain them, and we are also able to do products which nobody else is able to do because of this mix and match kind of stuff. And by making it fully automated for the end customer, as well as for our institutional partners, as well as for our banking partners, the cost of doing that mix and match and cost of doing all the analysis actually is very low. And this also encourages borrowers to not default, and also it encourages them to keep growing their business and keep getting better products, because that's our whole promise, is that if you keep performing on our platform as a business borrower, we will ensure that the next product that you get on the platform is better than the last product that you got.
Sure. So let's just talk about those products then. I mean, obviously you've got your banking platform, institutional platform, and you talked about the SBA loans that are on the banking platform. But can you just talk about the range of products on both platforms? I mean, are these 1 year loans, 3 year loans, 5 year loans? What are you doing?
Yes. So on the institutional platform, we have loans ranging between 1 to 5 years now. We go from, a typical amount anywhere from $25,000 going up to $1 million. We have products which are, bridge financing products where, let's say, a customer comes in and they need institutional money, but they can qualify for a bank loan, let's say 6 months or a year down the line. Then we'll give them a 3 year or a 4 year product with an early payoff discount, and will also facilitate through our banking platform an ability for them to get a bank loan. That's good for institutional guys because, they get their money back pretty quickly. They are able to, deploy that money back on the platform. And by putting out a bridge product, they're able to, attract some high quality customers. Then we have a typical working capital loans, which are anywhere between 18 months to 5 years. For, normal day-to-day working capital, there we have multiple products, which is a traditional working capital. We do a payroll financing product because we have partnerships with companies like Paychecks and some of the other large payroll companies. So we get a lot of data from these payroll companies, and then we have a payroll product for their customers so that these customers can meet their payroll needs. Most of them, the payroll needs arise because, some of these companies have got big contracts and they have a little longer account receivables and they need the money to bridge that gap. Then we also have a real estate backed product now in our institutional platform where we do a 5 year loan products against the commercial real estate, owner occupied commercial real estate. And we have modeled that product on an SBA product because SBA, if you see a large piece of SBA lending in this country is against business acquisition or for businesses who have some kind of a commercial real estate. So we have brought that product on the institutional side that has some very attractive yields, very low defaults, and also the ability that the banks are also buying those loans, seasoned loans of our institutional platform. So what we have done is that we have taken a lot of the banking products and put it on the institutional platform. And by doing that, we are able to provide credit to very high quality customers. We are also able to ensure very low default rates, and we are also able to ensure that our institutional investors, even if they invest in products ranging from 3 to 5 years, can get an exit, or a part of their portfolio can get an exit at par or at premium within a time period of 12 months to 24 months. So that keeps the whole engine chugging. And the whole premise that as a business owner, if you keep performing well, you can keep getting better products. So that promise is also there for the business owners. The institutional guys are happy because the way institutional loans are written is as if you're underwriting a bank loan, but without the bureaucracy and by fully automating it. And for banks, it's great because they're not able to compete in the primary market, but now they can come and buy loans of the institutional platform once they are seasoned.
Okay, so that's actually what happens. So it's almost like you have a secondary market. So
yes,
you've got loans coming in. They've got might have 12 months or more of payments, and then you're selling off these whole loans off to banks. That's fascinating. Fascinating. Yeah. So I guess what goes on your banking platform, is it really just SBA loans that that go on there, or how do you decide what goes where?
Yeah, so this is a very interesting question, and what goes where obviously gets decided by the loan terms, by the amount you need. So let's say if somebody qualifies for more than $1 million, it will go on our banking platform. But obviously, if the banking guys are going to take a little bit more time, then the institutions can fund it as a bridge loan. So typically what we see on our platforms is that, when the customer or business borrower is coming in, we are obviously capturing their financial information. We have built pipelines into IRS, we have built pipelines into their bank accounts, pipelines into their accounting packages, and we are able to calculate all the financial ratios, including debt service coverage ratios and their historical financial data. And at that stage, based on the customer preference, that how quickly they need the money, what for they need the money, we offer them both a institutional product and a banking product. And what we are seeing is that a large number of times the borrowers will pick an institutional product with a clear visibility that what kind of banking product that they can get. Now in terms of banking products, we have partnership with banks like Union Bank of California, TD Bank, Citibank, and now other banks are joining in. So what we have also done is that we have automated that process also. So let's say, you need a banking loan product, whether SBA or non-SBA, with these banks. And plus we have a large number of small banks on the platform. So you don't have to go and fill out their applications manually or anything. So all that gets filled through the platform, and you can see your options at any given point of time. A large number of time, what we are starting to see now is that, people are opting for a mix and match, especially the bigger borrowers, that they will take some institutional money and some bank money, or the institutional money gets refinanced into the bank money. Obviously, where it's an acquisition financing that we do bigger C&I deals. So what I mean bigger C&I deals are deals above $1 million. So sometimes they also go directly to our banking platform. But the beauty of the platform is that the customer can see all their options and they can decide which option they want to work with. So I think that is something very interesting on our platform, because, while we run a institutional platform, we also, by making it compete against the banking platform, and banking platform to compete against the institutional platform, all the best practices are transferred to each other. And at the end of the day, the customer gets the best products that they can get. And there's a motivation for them also to keep working.
Right. So you present a number of options to a borrower. Obviously some of them they're going to range in interest rates. They're going to range in loan terms.
Yes, and absolutely. And based on their preferences also,
right.
What they need,
Right. Sure. And then, so even if someone says, look, I want a 3-year loan, I want this amount, I want $200,000, even though it's pretty clear the loan terms that they want, you will still provide them with multiple options.
Yeah. We'll provide them with multiple options, and there's education stuff also there, because we'll tell them that if you go on our institutional platform, this is what you will get. These are the terms. This is the turnaround time and everything. If you go on the banking platform, then this is what you get. And then there's a third option that you can borrow money from the institutional platform and then can get a sort of a refinanced, or, the whole loan can be bought by the banks down the line after you have made all these payments. Okay. So a lot of people like that, because, then they have a clear visibility and they can borrow money quick and they can get what they want to do. without having to pay exorbitant pricing.
Right. Okay. So let's just talk about defaults for a little bit, because, I mean, you've obviously got a range of products, and, I imagine that some loans are more risky than others.
Yeah.
So give people a little bit of an idea about your default rates, and as well combined with the actual interest rate that you're charging, so we can get some idea of what those returns can be.
Yeah. So I think on the default side, the interest rate side, what we charge on our institutional platform to the borrowers is anywhere between 11 to 17% per annum. In terms of default rate on our institutional platform, over last 3 years, we have done over $300 million just in the institutional platform, and our default rate right now is only 0.6%.
Wow.
Actually.
That's impressive.
Yeah. And there's a reason behind it. And the reason is very simple. I would say 2 or 3 reasons. One, we don't source any of our deals through any brokers. So there are no ISOs on the platform. Every customer gets an intelligent dashboard. Every customer gets that whole virtual CFO stuff. Every customer has an ability to set up a free loan consultation. Every customer has the ability, every customer will not get that, but every customer has the ability and a visibility that what could be their exit path from an institutional loan could be there. So by keeping that kind of a tight underwriting, and by working very closely with the customers, and by using technology really well, and then we have our own Biz Analyzer score, which actually updates every month or every quarter. So all the loans that have been given through our institutional platform, we monitor them on an ongoing basis for Biz Analyzer score, and we can see, if any stresses are coming in a lot prior to them starting to, miss payments, or, if they miss 1 or 2 payments, then we start to do some workouts with them. So the benefit again there is that by having a mix and match of products, and by showing to the customer that you have a path towards a better and a better and a better product, because on the banking side, our interest rates are anywhere between 3.25%, which is US prime, to 6%. So there's a big, I would say, incentive for borrowers to keep performing on our platform, because the more they perform on the platform, the better they perform on the platform, it's easier for them to get cheaper and cheaper loans down the line. And also, if they're performing well and the loans are performing well, then the banks are willing to buy it at a premium, which we share it with our institutional guys. So that way institutional guys are willing to lower their returns. Like from January, we are launching some products on our institutional platform, where the rates will drop to 7 to 8%, because we know exactly how the performance of these loans are, what premium the banks will pay. So whatever money the institutions are, foregoing upfront, they make a lot more at the back end pretty quickly once they have a certain amount of portfolio. And then the other benefit of this is that we are the first dedicated SMB platform which has got leverage facility. So we have now leverage facility from Citibank and Nomura in place. And these leverage facilities are coming in at a very competitive price, much lower than cap ones of the world, like what they were giving. And the reason is because of high quality portfolios, low default rates, traditionally having a maturity period between 1 to 4 years, and the ability that banks can buy those loans for their CRA requirements. So the leverage guys really like that kind of stuff.
For sure. No, I can see that. So then I just want to talk about the investor side. So if someone wants to come on as an institutional investor today, firstly, can they, or do you have a waiting list, and what sort of minimum investment do you require? And I presume you only deal in whole loans. Is that correct?
Yeah. So right now we are dealing in whole loans. Starting in end of January, early February, we will also start, offering the syndicated portion of fractional loans, because our loan sizes have gone up, and we have more and more institutions want to join the platform. So we also want to diversify that, source of the money. So that's happening as of now. In terms of wait list, I would say right now, we have just added 4 to 5 new institutions. Some of them are pretty big, some of them are Asian and European institutions, pension funds and all that, have come to us, and they've been looking for 2 to 4 year products, from very high quality customers that they want to fund through our platform. So I would say, we are growing very fast, and what we are doing is that there are 2 ways to grow fast. One is to lower your underwriting standards, which obviously we are not in any mood to do that. But what we have done is that we have looked at a lot of market gaps and are transferring a lot of products from our banking platform into our institutional platform. So prime example was this whole real estate backed product that we recently launched. So when we look at the market size, we are saying that, by launching these kind of products, we are literally launching a private SBA market. And if you see the SBA market size, every year they do almost $40 billion in new lending, and they have like almost $800 billion in outstanding loans.
Mm-hmm.
And by also, increasing the deal size, we are able to capture a lot of C&I market, which are the commercial and industrial loans, where the banks still, with all their slow processes and everything, still do between 180 to 200 billion a year. So what we are saying is that by actually transferring a lot of banking practices into our institutional platform, but making it fully automated, fully seamless, by like helping customers and by monitoring them on an ongoing basis, because the typical challenge for a lot of alternative lending platform has been is that what size they can go up to at any given point of time. So like we are saying that if you can map out the creditworthiness of the customers, then you can do a larger size, you can take collateral, you can even have secured loans out there, and you can have a fractional opportunity for a lot of institutions, so that way they get a portfolio which is well diversified on our platform itself. Part of it could be bridge, part of it will be bought by banks, part of it would be working capital normal, part of it would be just for growing their business. So the benefit of that is that on a platform like Biz2Credit, and institutions are building very diversified portfolio, both from a loan product type, credit profile, as well as their exit options. So like some could be securitized, some, there's a secondary market already available on our platform. Mm-hmm. So that keeps their money constantly rotating. And that also helps the borrowers and the banks and then the institutional guys.
Sure. So what is the minimum then? If like particularly if you're starting a fractional platform and say there's someone out there who's listening, who's running a hedge fund or whatever and is thinking, I'd like to give this a try. What is your minimum that you will allow on?
Yeah. So right now the minimum that, we are allowing on the platform is, the first pool of money they can come in with anywhere between $250,000 to $500,000.
Okay.
Actually.
Okay. That's not too bad.
Yeah. And then obviously, and they can participate in those products. And obviously as it grows, then we might relocate to it.
Right. Sure. Well, before I let you go, I got a couple more questions about, one of the things that you offer, which I've seen mentioned in the press a little bit, is your small business lending index. So yes. Can you talk a little bit about that?
Yes. So, so small business lending index, we started it in January of 2011 with the premise that, we were seeing that there was a lot of, stuff going on where banks said that we want to lend money and borrowers said we are not getting money. So by having the underwriting criteria of the banks on our platform, so we divided them into big banks with assets over 10 billion, small banks with assets less than 10 billion, credit unions, and then institutional platform that we launched. So we also started mapping the approval rates. So the whole aim of the small business lending index was that, at one place, as a borrower, as a reporter, as a policymaker, as a lender, you should be able to compare, what is happening in the market, who is getting money from who is getting approved from whom. And over the last 4 years, Biz2Credit Small Business Lending Index has become the benchmark lending index in the country, so much so that it has been so successful that, starting in 2015, we are launching a Hispanic Small Business Lending Index in partnership with Univision. We are starting some city-based lending indexes now because we have got a phenomenal response from the lenders, from the policymakers. So Federal Reserve Board actually and Federal Reserve of New York actually partner with us. They get a lot of this data from us and then they analyze it on their own and then share it back with us. Federal Reserve has written white papers where they benchmark their senior loan officer survey data with our small business lending index data. So that has been very helpful. And our aim is to make the index stronger and stronger and also more focused by region, more focused by ethnicity, so that, we are able to figure out, what is happening in the industry and how we can build better products. And that's great also for our institutional platform because a lot of time when we are building institutional products, we exactly know what the banks are missing and what they will take in the secondary market and what kind of premiums they will pay out there. So that has helped us a lot to develop better products and be more innovative in the marketplace.
Right. And it seems like you also produce reports that are based on this index. I know there's some, just on your website right now, there's a whole bunch, anyone can go and download some of these reports, right?
Yes, absolutely. I think one of the key things that we are seeing in the small business marketplace, even more than consumer, is that there's a big change happening in this country. There's a lot of new, and especially with the immigration bill now coming in, and even prior to it, if you see the SBA data and other data, the fastest growing businesses are Asian Americans and say, Hispanic businesses. So we do a lot of these studies now on, by ethnic groups, because even Dodd-Frank has made it mandatory for lenders to know the ethnicity of their borrowers starting in 2016. But more than that, for us, it's something very interesting because we can figure out where the growth areas are. We are doing, studies, annual studies on top 25 metropolitan areas in the country by business growth, by loan performance, by industry. We are doing now studies on, women entrepreneurs, what they are doing, how they are doing, what kind of loans or how they're accessing loans, what they do with the money once they get it, how they are growing their business. So by having a very, I would say, granular approach on the data side, now we are able to, build better products. And also from a messaging perspective and the whole philosophy of being a virtual CFO is that if we know our customers better, then we will be able to produce the right content for them that will help them to do better out there.
Mm-hmm. Mm-hmm. Yeah, for sure. Okay, but before I let you go, just a couple more things. Just on where you're at right now, how many loans have you done? I mean, what's the sort of volume that's running through your platform today?
Yeah. So in terms of the institutional platform, what we have done now is that, we will be closing the month right now with a volume of almost 25 to 30 million, this month. And on the banking side, it's around 25 million, this month. In terms of our projections, what we are foreseeing and with new partnerships that we are launching in early 2015, we are targeting on the institutional platform almost $1 billion. And on the banking platform, also it will be in the similar range. Right now, our institutional platform is growing a lot faster than the banking platform because obviously, we have been able to introduce new products. We have got a lot of U.S. money and global money. And my take is that in 2015, a lot of banks are coming to us to buy these, cases or buy these loans, from us. And that way, we are able to, take it to the next level pretty quickly. And this whole interplay or the secondary market that we have set up, this is going to even increase our volume more because what we do on our institutional side, as these loan season and banks start, buying more and more of it. So that's going to even improve and increase the volume.
Right. And so, okay, final question. You obviously you saw the recent IPO of OnDeck. Obviously you're not in the exact same market as what they're doing, but you are a small business lender. Any plans to go public anytime soon?
So I think that's a very good question. We are growing very fast right now, and what we are thinking is that we are getting to go public sometime in early part of 2016.
Okay.
So 2015 is a year for us to keep growing very quick. We have grown a lot in 2014, and 2015 is a year to keep growing, build all the systems in place, so that we can go public sometime in 2016.
Okay. Well, great. On that note, I'll let you go. I really appreciate your time today, Rohit.
Yeah, thanks.
Okay. Hopefully you'll agree with me now that Biz2Credit really is a company to watch in this industry. I've used the word many times, but I found that fascinating that here's a company that is, providing small business funding and they're providing it at a pretty high level, but really digging into these small businesses and digging into their finances, providing that virtual CFO service. It's brilliant because, not only do you get potentially more loyalty from the business, but you really can make better underwriting decisions. And I think given their success so far and the amount of interest in this space today, I think 2015 is going to be a year where a company like Biz2Credit just starts to really dominate the space. So on that note, I will sign off. Thank you very much for listening. We've got lots more great stuff in store in 2015, and I look forward to chatting with you next time. Bye for now.